Purchasing power. Inflation erodes the purchasing power of money. As prices rise, the same amount of money can buy fewer goods and services. This leads to a decrease in the standard of living for individuals and households, especially those on fixed incomes or with limited financial resources. Income redistribution. Inflation can lead to a redistribution of income and wealth. Those who own physical assets like real estate or stocks may benefit, as the value of these assets tends to rise with inflation. On the other hand, individuals with savings in cash or fixed income investments may see the real value of their savings decline. Uncertainty. High or unpredictable inflation creates uncertainty in the economy. Businesses may struggle to plan for the future, as they find it difficult to predict costs and revenues. This can lead to reduced investment and economic growth. Interest rates. Central banks often respond to high inflation by raising interest rates to control it. Higher interest rates can make borrowing more expensive, leading to reduced consumer spending and business investment. Savings and investment. Inflation can discourage people from saving money in traditional bank accounts or low-yield investments. Individuals might be more inclined to spend or invest in riskier assets to try to outpace inflation, potentially increasing financial instability. Wage pressures. While inflation erodes purchasing power, workers may demand higher wages to maintain their standard of living. This can lead to wage price spirals, where businesses raise prices to cover increased labor costs, which in turn can lead to even higher inflation. Fixed income recipients. Retirees and individuals who rely on fixed pensions or government assistance may struggle to make ends meet if their income doesn't keep up with rising prices. Distortion of economic signals. Inflation can distort economic signals, making it harder for businesses and consumers to make informed decisions. For example, the real profitability of a business may be obscured by nominal revenue growth driven by price increases rather than increased demand. Global competitiveness. If a country experiences significantly higher inflation than its trading partners, its goods and services may become more expensive relative to those from other countries. This can reduce the country's export competitiveness and potentially lead to trade imbalances. Social unrest. In extreme cases, hyperinflation, very rapid and uncontrollable inflation, can lead to social unrest, economic instability, and even political upheaval. It's important to note that the impact of inflation can vary depending on its rate, duration, and the overall economic context. Mild and stable inflation is generally considered normal in a growing economy, as it can provide incentives for spending and investment. However, excessively high or volatile inflation can have significant negative consequences for society. Central banks and governments often aim to strike a balance between controlling inflation and fostering economic growth and stability.